Good day. Welcome to my talk on development and distribution, and thanks to Ruichi Tanaka for inviting me. I'm so sorry that I'm going to have to move a little bit quickly. I hope you won't mind and you'll be able to get the slides later on, or maybe Ruichi and some of the others will be able to ask more detailed questions that you might have. So, I want to talk about the connection between development and inequality, and I want to start with an old story which goes back to Harry Oshima and Simon Kuznitz's pioneering work. They talked about what is well known now as the inverted U hypothesis, which is the idea that inequality tends to rise and then fall over the course of development. Now, Oshima and Kuznets had in mind really one transition from agriculture to industry. And it was very natural for them to think of inequality rising and then coming down in a very hopeful view as development proceeds. Unfortunately, we don't see that in the world. Not because Oshima and Kuznets were wrong, but because there have been many other transformations that did not exist in their lifetime. So here we have, for example, the share of the top 10% in national income for different countries. You can see the listing of the countries below, and you can see that especially after 1970, there's been a pretty dramatic rise in economic inequality. Now, we all know that Japan is a relatively equal country, but Japan also displays the same trend. There's the share of the top 10% in national income in Japan after the Second World War, and you see that this share has exhibited a secular increase. Yeah? If you look at just per capita incomes of the top 10% and the bottom 50%, this distinction is even more dramatic because you can see the blue line shows how the top 10% incomes have been rising, whereas the bottom 50% average income has been essentially stagnant over this period. Now, what role does economic theory have in helping us understand some of these phenomena? Well, there are essentially two views on development and distribution. One is that economic inequality is really an ongoing battle between the tendency to converge, as in the Solow model, right? Individuals within a country will tend to have similar incomes, but there are stochastic shocks that are keeping them apart. This is a very hopeful view of markets, right? That they tend to equalize. As opposed to this, there is the disequalization view, which argues that markets intrinsically create and maintain inequality. And this is a view that I am going to talk about in a bit more detail, especially since we don't see this so much in introductory economics courses. Now, either of these views, anyway, would have to run through two channels, which we can think about as the functional distribution of income and the personal distribution of income. Right? So here, for example, you have a very familiar macroeconomic diagram where you see households demanding consumer and capital goods. These consumer and capital goods, when they're produced, give rise to incomes for labor of different skills, as well as capital and land and so forth. And these red arrows you can think of as mapping the functional distribution of income, telling us how from production we go to payments to different inputs. But then, of course, these inputs have to be held by households, and we can think of this as the personal distribution. So the blue arrows tell you how these inputs map into household endowments. And taken together, the red arrow and the blue arrows give you an overall view of economic inequality and income distribution. Now, a theory of economic inequality would ideally address both of these components, but given my limited time, I'm going to only selectively highlight some aspects. And in particular, I'm going to focus on the functional distribution. Yeah? So let me then turn very quickly to the functional distribution. And here, just in parallel to what we talked about earlier for markets equalizing or disequalizing, we have two views. One set of views is that input price ratios over time tend to converge to some steady state or balanced growth, right? Is the view which goes all the way back to the work of John von Neumann. Yeah. And of course, the question of personal distribution is still a problem in this setting because the endowments may be held unequally, but at least the input prices tend to converge. As opposed to that, there is the view of uneven growth, which really stems from the work of Oshima and Kuznets and Arthur Lewis and others, which is that there's an ever-present movement of relative input prices. Input prices tend to move around, and this tends to exacerbate the personal inequality problem. And it's this second view, this uneven growth view, that I want to talk about in a little bit more detail. Now, the uneven growth view may manifest itself in two ways, right? One is that it could have possibly deep and persistent effects on the ratio of unskilled to skilled wages or labor of different types. And this is, of course, a very important component of economic inequality, which could be due to technological change, ongoing globalization, and of course, as I told you, we expect that from the work of Kuznets and Oshima and others. But there is another view that I want to highlight in this talk, which has to do with the possibly changing capital labor shares in national income. So in other words, under this view, even if I clump together all the different kinds of labor, there is a real sense in which the overall share of that labor may be diminishing relative to capital. And this can be a deep cause for concern because it necessitates then that in the interest of overall inequality or overall equality, that individuals have enough opportunity and the acumen and the skill to accumulate non-human capital. So let me go then a little bit more deeply into this second aspect, which I want to focus on. So here is what we might call the death of a Caldor fact. Okay, so this is the Caldor fact. The Caldor facts refer to many constancies, right, like the capital labor ratio, the share of labor in national income, and so forth. And one of these, the share of labor in national income, seems to exhibit a fairly significant declining tendency over the last 50 years or so. This is a diagram which looks at the imputed share of labor in national income. It's imputed because you have to worry about self-employment, which is a very large fraction of national income, and it's unclear how to allocate self-employment, whether you allocate it to labor or to allocate it to capital. But as this work of Veronica Guerriero shows, that even under 6 different imputations of self-employment income, in different ways to capital and labor, and that's why you have these 6 lines, you see an unmistakable tendency for the labor share to decline. Yeah? Now, if you just look at incorporated income, so that the self-employment problem is thankfully missing. If you look at individual countries, I've got here Japan and China and a couple of, the United States and Western Europe, and you see that this tendency for a decline in the labor share is quite ubiquitous. Another way to see this is to look at the labor share trends, which is the percentage points decline or increase. This graph is kind of located around 0 over the last, over 10-year periods. And on the horizontal axis of this diagram, you have many different countries. So let me highlight a few of them: China and Japan and the United States and Germany and so forth. And you see that the overall tendency is for this labor share to fall. Now, one might argue that this is happening because somehow the composition of production is moving from stuff that's labor intensive to capital intensive, so it's a compositional argument. Well, that's not entirely the case, though of course some of that may be happening. We see that there is a decline labor share trend in different sectors of the economy as well. Yeah? Okay, so how would we think about explaining these trends? Well, one that comes naturally to mind is the so-called China shock. I don't mean shock in a bad way. It's the huge impact that China has had on the global economy. And one might imagine that because of this, there would be a tendency for wages to drop everywhere because of the competition being posed by relatively cheap labor in China. There may be some of this, I have no doubt about it, but it cannot be anywhere close to all of the explanation because you see the declining share of labor in countries like China and India as well. So India, for example, has this phenomenon called jobless growth. I'm going to come back to it, where there's been huge increases in per capita income, but very correspondingly little increase in employment. The other argument we can make is that maybe there's been a change in concentration moving away from labor to capital in terms of market power. For example, the rise of the gig economy or decaying strength of unions and so forth. Now, This may again explain some of these changes in inequality, but of course we'd have to explain why there's been a decline in this labor power in the first place. Or one might invoke the idea of technical progress, that somehow technical progress is just making machines more and more efficient, let's say advances in robotics or machine learning and so forth. But of course, we are all philosophers here, and at some level we must ask the deeper question of why must technical progress necessarily displace labor as opposed to capital? There's no particular reason why that has to be the case, right? But it may well be that that's in the nature of technical progress and explains part of it. My favorite argument has to do with something which is much simpler than these three, okay? And it actually goes back to an old theory due to David Ricardo, the Ricardian theory of rent. Now, let's remember that Ricardo, in his time, what was the scarce fixed input? It was land. And other stuff like labor and capital were increasing relative to land. And so there was this ongoing pressure that land was soaking up a lot of the returns from capitalist production, right? What would that mean? It would mean that there would be an ongoing tendency to substitute away from land as an input. For example, by perhaps having production methods that rely less on space, or by expanding vertically, as we know in Japan and in many other countries. Yeah. Now, fast forward a couple of centuries, and we can really replace land by labor because it's now human population that's fixed. Now, of course, you might say human population is growing, perhaps at a very slow rate, but that's not my point. My point is that essentially this object is exogenous. You can divide by human population if you like and look at the per capita effect. But what's endogenous is the fact that we're getting richer and we're accumulating capital, non-human capital. Of course, we're accumulating human capital as well, but we're accumulating physical capital, and this is growing per capita. And when it grows per capita, just as in the Ricardian view, we will tend to substitute away from labor. And we definitely see this happening. So if you look at, for example, this diagram, which looks at the prices of investment goods over the last, 50, 70 years, you see that there is a tendency for the price of physical capital goods to be falling relative to labor. Not only that, it's not just the prices falling. You see this in the employment elasticities of different sectors, right? So here you have a table where I've broken it up into three different sectors: agriculture, industry, services. And employment elasticities, just to remind you, it means the percentage change in employment that occurs when there's a 1% increase in output. And you see that these numbers are extremely low. And when they're not low, they're actually negative, right? So I've highlighted Japan here because, this is a talk for a Japanese audience. But you see this all over the world, that employment elasticities by sectors are extremely low, okay? The only exception being, of course, services. Yeah. The same thing is mirrored when you look at overall GDP growth by country, okay? And compare it with employment growth by country. And here I've chosen to emphasize a different set of countries. I'm looking here at some developing countries, just for variety. And here I'm emphasizing India. If you look at India, over 1991 to 2000, India grew at 5.7%, very, very high. Yeah. But what was its employment growth? A paltry 0.6% per year. Yeah. If you look at the later period between 2001 and 2015, the disparities are even more stark. India grew at a thoroughly impressive 7.09% per year, whereas its employment growth remained the same, 0.6% a year. So there's clearly capital labor substitution that's going on. Now, capital labor substitution, as I told you, is an intuitively compelling idea. There's nothing intrinsically wrong with it, because as growth is occurring per capita, capital is going to become plentiful relative to labor. So it makes perfect sense that the relative prices of capital goods should fall, and there should be a movement away from labor towards hiring capital. But I want you to notice that this sort of theory makes no predictions about the share of labor in national income. And the reason it doesn't make a prediction about the share of labor in national income is because two things are happening at the same time. The amount of labor used in production per unit output is falling, okay, so the capital labor intensity is going up. But at the same time, the wage rate is going up. That's why the capital labor ratio is going up to start with, right? Is because the wages are getting more, human labor is getting more expensive relative to physical capital. And as a result of that, the share of labor is really the product of these two things, right? Which is the price of labor multiplied by the amount of labor that's being hired. And that bears an ambiguous relationship in terms of overall share of national income. So for those of you who have some economics background, if you think of the Cobb-Douglas production function moving along a particular isoquant, then you will see that, that the share of labor there is always constant, no matter what part of the isoquant you're on. So, but this move in the functional share, therefore, is not immediately obvious from capital labor substitution. I know this slide, by the way, has an intriguing title, but I'm going to come back to that in a minute. This move in the functional share of income of labor has inspired a lot of recent research, and one of the more famous pieces of recent research on this is Thomas Piketty's book, Capital in the 21st Century. Now, he's very concerned about this declining share of capital, this tendency for income to move to capital owners. Yeah? And as a result of this, Piketty describes three fundamental laws of capitalist development. Frankly, I have written about these things elsewhere. I'm not sure, whether they are more laws or accounting identities, but definitely they're trying to address this question of the declining share. Okay, so he talks about an accounting identity on capital income, the Harrod-Domar equation, and this famous formula R bigger than G, which I don't have time to go into, but these are attempts to describe the decline in the functional share. They don't really explain the decline in the functional share. So, but in any case, in homage to Thomas Piketty, I want to introduce my fourth fundamental law. I'm going to call it the fourth fundamental law of capitalism, which is that with economic growth, capital displaces labor. This we've already talked about. This is fine. But more than that, that the labor share in national income must progressively vanish. Now, you might ask, am I serious about this being a fundamental law? In what sense is it a fundamental law? After all, it's not really directly testable even, right? Because I'm talking about something that's progressively going to vanish in the long run. And as Keynes reminded us very sadly, in the long run, most of us in this audience and me will not be alive to see it, right? But it's really, in that sense, only an indicative statement about a long-run tendency. And yet, I want to argue for you is that it's a fundamental device for organizing our thoughts, just in the same way that it organized Piketty's thoughts, except that I am going to give you an argument now, which has to do with why the labor share in national income must progressively vanish. Okay, so I want you to, I beg your patience for a couple of minutes while I try to explain why this law is likely to hold from a conceptual and theoretical viewpoint. Yeah? So the argument I'm going to make for this fourth fundamental law rests on two pillars. The first is a dual idea of what physical capital is. Okay? It's two kinds of capital, one that's complementary with labor, which I'm going to call machine capital, and one that is substitute for labor, which I'm going to just call robot capital. Now, when I say robot, I don't want you to imagine, a big machine coming at you, swinging its arms menacingly. It could be artificial intelligence, it could be software. It's a catch-all for capital that's a substitute for labor, right? The second pillar is I'm going to emphasize a fundamental asymmetry across human and physical capital. Okay, I'm going to come to that a little bit later. Okay, so you're looking at some equations. Don't worry, I'm just going to put them up here very quickly for you to organize your thoughts. Think of there as being many sectors producing many goods, capital goods, consumer goods. And in each sector, there's output which is being produced using KI, which is machine capital, and here's KI, and LI, which I want to think of as tasks, right? And these tasks may be produced by humans or robots. In other words, automation is going to be feasible in each of these sectors, which of course doesn't mean that it's profitable. And so this setup captures the fact that capital comes in two flavors. It comes in the flavor of machines, which I think of as complementary to labor, and it comes in the flavor of robots, which I'm going to think of as substitutes for labor. Yeah? Okay, that's the first pillar. The second pillar is that we are holding claims to physical capital and we can scale up those shares in any way we like, of course, subject to our budget constraint, but we can easily move them up or down. But human capital, our claims on human capital, because human capital is not alienable, right? Human capital claims cannot be replicated in the same way. They reside in one physical body. Now, of course, to some extent, that physical body can be made more efficient in a particular occupation. But the main way in which human capital is accumulated is not within an occupation, where it's only partly scalable, but it moves over occupations. Now, you might say, from a macroeconomic perspective, why does that matter whether it's within an occupation or across occupations? And the answer is that it does matter because of the composition of demand for different products. So I'm going to come back to that issue in a little while. But for now, I'm going to combine these two pillars to make the following claim, that as physical capital per capita accumulates in any sector, tasks in that sector must become progressively automated. That's the first step towards showing this fourth fundamental law. So the way I'm going to prove it, I'm going to argue by contradiction and say, I suppose that this claim is false. Okay? That means that the tasks in any sector, even if it's growing, is never fully automated, that there's a share of those tasks which are being performed by human labor. Now remember that we are holding human labor in the Ricardian sense as fixed, and we're looking at everything on top of the treadmill of human labor. So it means, step one, that there must be ongoing upward pressure on the sectoral marginal product of tasks. And step two says that that ongoing upward pressure has to result in ever-rising human wages relative to the price of physical capital, okay, in that particular sector. Now notice how this relies on the human-physical asymmetry, because if you can accumulate capital, human capital, without bound in any one sector, then this argument would not be true. But it's precisely because that human capital is partly scalable only in any one sector is that this argument is working. Step three is crucial. The step three says that under these conditions, the human wage rise must outpace robot prices. Okay? And I'm going to go very quickly through it. Think of the robot production, okay, or the production of artificial intelligence or hardware robots. These prices inside a market economy must be a mix of the machine capital that's required to produce them and the tasks that are required to produce them. Okay, so I've got a little equation saying the price of capital and the price of tasks map into the price of robots. But of course, in the robot sector, the price of tasks is itself a mix of robotics in the tasks sector for robots and human wages in the robot sector. So the price of robots and human wages in the robot sector map into the price of tasks. Now, if I put these two equations together, I see that overall the price of machine capital and human wages map into the price of robots. So of course, as human wages grow, the price of robots is going to go with it. Yeah? But not in the same ratio, because robot production also relies on physical capital. Okay? So combining these two arguments, we see that the price of robots divided by the price of physical capital, PR divided by PK over here, right? It grows, but it grows more slowly than W divided by PK. Okay? But when that happens, we have a contradiction, because it will mean that there will be ever-present substitution in the task sector, moving away inputs from human labor to automation. So step 4 says that step 3 generates persistent task replacement by robots. That contradicts our initial assumption, and so the claim is proved. Okay? Now, we might argue that no sector grows unboundedly even if there's growth overall, because it may be that growth is happening not through the growth of any one particular sector, but through an increase in the variety of sectors. Yeah? So the number of sectors must grow without bound. But one can show that the same sort of argument applies as long as human preferences are neutral to labor intensities across different sectors. Yeah? And I'm going to come back to this issue in a minute or so. Yeah? So to summarize, all of this leads to what I call the fourth fundamental law of capitalism, which is that the labor share in national income must progressively vanish. Yeah? Now, notice that this statement is not a statement about absolute impoverishment or not a statement about absolute wages. In fact, unless technical progress is just inherently biased in favor of machines, it must be that the absolute wages have to increase to provoke the ongoing automation which has to occur because of the fourth fundamental law. So really, we are talking about a relativistic battle between capital and labor. And in the presence of economic growth, it's capital that's winning that battle, according to the theory that I've just talked to you about. Now, we might say, I don't believe the fourth law. Well, let's challenge it head on. Let's think about escape routes from the fourth law. Right? Well, the first is that I've assumed that there's going to be ongoing per capita capital accumulation. Maybe there isn't. Maybe the economies of the world are going to rise to a maximum level of per capita income and stagnate forever. If that's the case, then there won't be ongoing pressure on the human wage and the labor share will indeed settle. So a weaker way of seeing the fourth law is that in the presence of economic growth, the labor share has to vanish. The second argument may be that maybe some sectors just can't be automated. Maybe they're completely protected for human beings, right? Think of philosophers, poets, novelists, musicians. Well, we know from ChatGPT that even these things may not be protected. But leaving that out, let's suppose they are indeed such sectors, which are just human sectors. Yeah. Well, we still have to ask the question of whether there will be enough market demand to sustain these sectors. And this is why the composition of demand is so important to these arguments. And this is what's missing when we do aggregative macroeconomics. Okay? Now, of course, there's one particular type of human sector. We might say that human beings will always be around as researchers, as teachers, as educators. Well, I hope that's true. But I wouldn't bet my money on it. Yeah, I certainly wouldn't bet it on education. I also wouldn't bet it on the development of robots or artificial intelligence. It is well known now that we might be heading towards some sort of singularity where it will require very high levels of artificial intelligence to develop the next rounds of artificial intelligence. I'm not trying to argue that we are anywhere close to that singularity, but the production of robots by means of robots, to paraphrase an old phrase of Piero Sraffa, is not by any means a conceptual impossibility. There may also be, leaving out these issues, there may be perhaps a constant appearance of new human-friendly sectors, as if by divine accident. The new sectors, the new goods that are born may be more and more labor-intensive, and that might protect us. Well, again, I wouldn't bet on it. It would depend on the composition of demand as income changes. Should we expect our demands for different goods, think about tourism on the one side and think of iPads on the other side. Should we expect an increasing bias towards tourism, which is human friendly, or iPads, which is capital friendly? There's no particular reason to believe that either will be the case. If you want to, assume that our composition of demand will always move towards human friendliness, then we're okay. But if not, this is not an argument that we can entirely rely upon. Yeah. And finally, of course, we could argue, just as we argued before in the opposite direction, that technical progress might always create new methods, new tasks, which can only be done by humans, with automation happening later. Okay? Now, that's an escape route only by specific assumption. There's no particular reason why that assumption should hold. And if you think about, in fact, technical progress being directed, there's every reason to believe that the opposite will hold, because technical progress, which is directed, will tend to attack those inputs which are relatively expensive and substitute away from them, right? In our argument, it's human wages that are becoming relatively more expensive. And so, if anything, if you have endogenously directed technical progress, it'll tend to move away from human labor and reinforce the fourth law. So, to summarize, the fourth law argument has the following features: ongoing economic growth, the progressive cheapening of capital relative to labor, the vanishing share of labor via automation. It's a relative malaise. Rising absolute wages are compatible with the law and often necessary. The fourth law really captures, as I was saying, an age old anxiety that capital is going to inherit the earth. Now, of course, the extent of that anxiety depends on the ease of capital or skills accumulation by individuals, right? So, if you remember this diagram that I put up earlier, the fourth law really talks about those red arrows, about the functional distribution across labor and capital. And of course, these can be compensated for by the blue arrows, which determine the different endowments that individuals are going to hold. Yeah? Now, in this part, which I'm not going to emphasize, but I just want to mention it, the themes of convergence and divergence reappear exactly as they did for the functional case. But they reappear even without any changes in the functional distribution. Yeah? So what would happen, for example, is that society, the functional distribution will determine different ownership categories in societies. For example, incorporated capital, the holding of shares in different enterprises, which I've depicted by a sort of slender horizontal line, trying to show you that you can hold these objects in divisible ways. Or they could be unincorporated enterprises, which are arrayed by setup cost in this little diagram, where you could transition from one business to another. Or they could be human occupations, doctors and lawyers, or God forbid, economists, right? And there could be intermediate categories. For example, you're 3 years in secondary school, nothing is happening just yet, but you can think of that as a category with a present value of its own. Or you're 2 years in college, deciding where to drop out or continue, and so forth, right? So one way to think about it is that the functional distribution determines values for these categories, right? Economic values for these categories at every date. And it also determines switching costs across every pair of categories. For example, you could go from being in the 2-year category of college to dropping out, or continuing into your 3rd year of college, or you could set up a business. All of these would move you into different categories in economic space. And notice how broad this idea is, that you could think of holding different amounts of capital or different quantities of shares as different categories, right? But of course, there would be switching costs, the cost of investment or the cost of education for all of these things. Yeah? Conversely, these choices, once they're made by everybody, will feed back on the functional distribution of income. So the system is profoundly interactive. So that's how the personal income distribution is determined after we know what the functional distribution is. Except that the words before and after are not to be taken literally, because all of these things are happening simultaneously. Anyway, the long and the short of it is that these societal outcomes display persistent personal inequality, typically. And even unchanged functional inequalities cannot be eliminated by the personal accumulation of endowments, let alone evolving functional inequalities, as we've talked about under the fourth law. Right? So each layer, the functional and the personal, gives rise to separate questions of policy. And decentralized individual behavior cannot spontaneously solve them all. You know, I think personally that financial education is more important than sex education, and it should be taught in primary school or secondary school, because this idea of holding capital, holding equity, is so fundamentally important in a world of encroaching automation. But on the assumption that individuals cannot, or unable to, or unwilling to solve these issues on their own, and most of the times it's because they're unable to, okay, because of the presence of wide inequality in the first place, I want to end by discussing a philosophy or a policy for the long run. I want to start by talking about universal basic income, which is a topic that all of you have heard about, and I don't want to repeat myself too much over here. But I want to point out to this audience that things like universal basic income is debated today even in the poorest countries like India. So I want to direct you to a particular issue of the Ideas for India, which is a web publication. It's a wonderful publication. And I want you to look at the special issue that they brought out in 2016, which discusses universal basic income for a country as poor as India. Also, the Indian government's economic survey in 2017 talked about this. And of course, there are the usual pros and cons. Are these truly universal? Should they be targeted? What are the economic incentives? All of these are being discussed now in the world, even in poorer countries. Now, just for the fun of it, let's think about how expensive it is for India, right, which is a poor country. Now, as you might know, India is full of redistributive schemes and directed subsidies: food, fertilizer, transportation, electricity, water, and so forth. And this is not even counting state-level subsidies. These are just at the level of the central government. Now, if you look at the monthly poverty line for India, India is a country of 1.4 billion people. If we think of providing everybody with a universal basic income equal to the monthly poverty line, we're talking about something like 8% of GDP, which is large, but not crazy large. For example, central government of India spending is around 12.5, now maybe 14% after the pandemic. Yeah? So just to give you some sort of benchmarking, that even though it is very small and for a poor country at a pretty low level, universal basic income is still something to think about. Now, I've deliberately given you this Indian context just to show that it's incumbent on all countries, rich and poor, to take a position on these issues for the long run. So you can think of universal basic income, or the universal basic share of national income, right, as a dividend which is payable from national wealth. Many of you know about the Alaska Permanent Fund. Yeah, it's based on natural resources. It takes 25% of state income from natural resources and pays out a citizen dividend. Yeah, there's, of course, all of you probably know about the Norway Fund. Again, resource-based. It is about $220,000 per Norwegian citizen. It could pay out dividends, but as of now, it doesn't. Yeah? And then, of course, there's the fund closest to home, the Japan Government Pension Investment Fund, which, possibly depending on movements in the exchange rate and the exact comparison with China, is possibly the largest sovereign fund in the world, valued maybe in the last part of 2022 at 1.4 trillion US dollars. Now, the China fund is about the same size. The Norway fund is around 1.2 trillion, yeah? But of course, we need to correct this by the population, right? China has, over 1.4 billion people. Japan has 125 million people. Norway has 5.4. Yeah? So even though this is a huge pension fund, even a country like Japan, rich as it is, I think could take a step or two further. But since, it's not my position or it's not my place to give you advice about what should be done in Japan, I want to end by talking a little bit about the situation that we're proposing in India. Yeah? So our question is, why shouldn't sovereign funds go beyond pension needs? Or why shouldn't sovereign funds go beyond natural resources? This is both a philosophical and a pragmatic question. The philosophy is clear from the first part of my talk: the fourth law, right, and market divergence. The pragmatics of how to do this comes from the logistics of fund building, and there's been lots of, proposals, mainly in the academic sphere, based on charity, based on financial transactions taxes, higher taxes on capital income, transfer of existing government assets, for example, from spectrum auction proceeds, and so forth. But this is the proposal that Purikit Ghosh and I made for India, which, we've been debating and discussing. It's something for the long run. And so just to be provocative, I will return to India to end my talk. Purikit Ghosh and I argue that India and developed countries should build a sovereign fund. And this sovereign fund should hold a portfolio of equity, bonds, and other financial assets. They would be managed professionally, just as any other fund is managed, subject to certain constraints. A fraction of this return can be paid out as a citizen's dividend. But of course, the payout will be slow. Patience is of the essence. Our proposal is that there should be a one-time directive on existing publicly traded companies, let's say on the Bombay Stock Exchange, that we have to issue X%, where X is a number that you can think about, of the existing share base as new shares to be held in the fund. This is going to create an immediate dilution of shareholder value. transferring it to social ownership. And there would be an ongoing directive to transfer X% of every new share issue, whether it's an IPO or an expansion of the existing share base. Now, the great advantage, I know there are disadvantages, but let me first talk about the advantage. The great advantage of this proposal is that it proposes payment via dilution, which is conceivably for us the most compelling point in favor of the plan. Stock issues by listed firms are easy to track. You don't have to audit the portfolios of individuals. Every investor automatically pays. You do not have to know what they own. Yeah? No payment is required in cash. No liquidity problems, no complaints about making payments. As one might tell Elon Musk, just send us the stock and save the brokerage fee, right? So that would be the fundamental idea. Now in India, this is especially compelling because we don't know who is holding what sorts of shares in what companies. And especially now with the internationalization of wealth ownership and the difficulty in tracking these things across countries, this idea of a fund based on partial share dilution may even be a great idea for many developed countries, including Japan. Okay? This fund would also separate ownership and management. So this is not classical socialism. The state is not going to have voting power in these individual corporations. If you want to explicitly make that clear, to avoid state from getting rights over corporate decision making, you can only issue Class B shares to the state, no voting rights. The other great advantage is that this would make for good political incentives because citizens who are the common heritage, who are the common owners of these funds, would come into closer political alignment, right? Because the fund would derive its value both from the input of labor and from the input of capital. So there would be a common alignment across these two great factors of production. Of course, I mean, this is not to say that the redistributive motive is entirely absent, but it would bring the politics into better alignment. It would bring other functional alignments, for example, attitudes to protectionist policies, attitudes to sector-specific taxation or subsidies or directed credit, right? All policies, in fact, that might redistribute or redistribute the other way at the cost of reducing the aggregate pie, because the aggregate pie is going to determine the value of this fund. And the reason behind these conflicts now, today, is not personal inequality, but it's really the discrepancies in relative asset ownership. And by having a universal fund, having a sovereign fund, we narrow those discrepancies across individuals. Now, this is not to say that these objects have no limitations and no concerns. Okay? So among the most important thing is the idea of the incentive effects of dilution, right? So the initial one-time dilution of an existing share, of course, has no distortion. It's almost like having a lump sum tax on an existing base. But of course, that could change if the one-time pledge is to be regarded as non-credible. So one would have to make a credible commitment towards this dilution being one-time on the existing share base. But of course, there could be additional distortions because this proposal also says that new fund issues are also going to have to be partially diluted, right? But these sorts of distortions are common to all forms of taxation. Except for the purest form of lump sum tax, all taxes are distortionary. Okay? For example, it might change the capital structure of companies. You might start swapping out equity for debt, or there may be reconversion of publicly traded companies into proprietorships. One expects that if X, that percentage is not very large, that these effects are not going to be very large either. So I'm going to conclude. I've taken up a lot of your time. I'm going to summarize. We've studied some aspects of economic development and income distribution. We've focused mainly on functional distribution. And among the functional distribution, we've talked about the declining labor share. Then we've commented very briefly on the personal distribution, that there is still another step to be taken to convert functional outcomes into interpersonal distributions. And there's so many aspects to consider, right? Even within the functional world, we could think about earnings differentials across skills. We could think of the relationships to Kuznets-Oshima cycles. Among personal distributions, we could think of the determinants of limited access to different occupational categories or switching across categories, savings rate, credit market imperfections, risk tolerance, and so forth. But the main lesson of all of this is that labor really is the only endowment we have, that we are born with. But we cannot rely on labor forever. We have to rely, with the growing encroachment of automation and with other technologies, we have to rely on the accumulation of non labor endowments. And to this, there can be two kinds of responses. There could be individual responses in a decentralized fashion, and there could be social responses which the government takes on. And it's the latter which includes the possibility of a universal basic share in national income. And I've ended by talking about the possible building of a sovereign fund to support such payouts in the very long term. So thank you very much for listening to me. I'm sorry I went a little bit over the allotted time, but I hope you found the talk interesting. Thanks.